Hi everyone, thanks for attending. Welcome to New England Winter Outlook for this coming winter, presented by us, the Genscape crew. So if you do have any questions, please type in into GoToWebinar, little box provided, and without any further ado, we're going to start. So the presenters are me, Natalia Mistrishvili. I'm the Regional Director for New York, New England, and joining me is Jesse Fitzmaurice. He's an analyst for New England team, and Wei Chan, who is our gas analyst. So just to start agenda, we're going to review last winter, just go through the outliers, what we saw, how the gas settled, the pricing, and then follow it by our expectations for winter 2013. Start with demand temp analysis, gen, transmission, look into the winter reliability by New England ISO, imports, exports, gas, and just summary, and answer any questions that you have. So just a quick look back for looking at temps at the weather. We had actually a warmer than average temperature pattern for last December, January, February, with a few cold snaps. We did have high wind events of January 31st and blizzard of February 8th and 9th, if any one of you remembers. So this is just a quick chart to show you our monthly averages as well as the strongest DAM and RT hub settles that we saw. So overall, December, the average on-peak load was around 15.5 gigs with a $50 settle with $5.70 on gas. Those are on-peak averages, and they exclude weekends. January, we climbed slightly to 16.5 with 95 average settle, 11 on gas, and February was 17.1 gigs with 135 average settle and around $17 gas. The strongest days that we saw in December was 16.5 gig loads. That's when the gas climbed to 10.4. January 25th was 18.4 gigs, 261 settle in day ahead and 217 in real time. So pretty strong prices over there with 34 on gas, and February 12 with $269 settle, and that's your $24 gas. The strongest gas prices that we saw last year was definitely the $35 range, January 25th. But from, and as you see from presentation, we did think it was more of an outlier. We also had the coldest 5-day snap of weather, the coldest, similar cold temperatures that we experienced probably was 2009.
Yeah, I believe it's 2009 is that 4-day stretch in January.
This is just another way of presenting to you the gas pricing that we've seen. So just to show how much of an outlier last year was, we just grabbed data for the past 5 years, starting 2009. And the crosses that you're seeing, those are the highest recorded gas for those years during those winter months, and the averages. So as you can see, the $34 is definitely an outlier that we saw last year. This is just another more graphical way of representing what was going on in New England versus the rest of the country. And the main reasons were definitely the blizzard Nemo that we saw. So we had a couple of unfortunate circumstances. We had pipeline constraints, West to East pipeline constraints. On top of that, our oil units were not ready to be really called on, so we were really low on oil inventory. So that definitely affected gas pricing and availability overall for New England. And Nemo, that caused the cold weather, created challenges for fuel deliveries. The blizzard itself resulted in like 6,000 megawatts of gas and oil generation becoming unavailable for those couple of days. And the combination of those events resulted in strong gas pricing. So that's just pretty much in a quick snapshot of last winter. And now going to looking at this coming couple of months. We do expect colder than usual, the normal temperatures for this winter. The December months, 1 or 2 degrees cooler with, as you know, this cold snap coming in on Wednesday and Thursday. January is going to be the coldest month, on average 3 to 4 degrees cooler in some parts of Mass. And then it's going to slightly warm up in February with just 1 or 2 degrees cooler. This is just another way of representing the our demand through heating degree days. And you can see on average it's very similar to other years. So pretty much slightly normal to slightly cooler temperatures and demand anticipated this winter. Again, you will get those slides and recordings at the end of the presentation, so you'll be able to dive into more details. But if you do have any questions, please type them in. Jumping into transmission, those of you who have been looking at the market are aware of the fact that Long Mountain Pleasant Valley 345 kV line went out. Initially, so it's out this week, supposed to come back on the 21st, and then we anticipated to go out again in January 8th till the 14th. Initially, we did think it would be similar to Berkshire to Alps outage with a D rate of 900 megawatts, and they did post those D rates on Saturday, but quickly changed them down to 550. So we've been seeing only 550 megawatts of imports from New York into New England, was slightly higher in the day ahead yesterday. For today's same clear, and for tomorrow's, I think it came down even lower to 500 and 550. So that's definitely bullish to must hub pricing and keeps those flows on the low side from New York to New England. Now going to generation, Jesse will take over from now on.
Good afternoon, everyone. I just want to thank you for joining our webinar. This is Jesse Fitzmaurice here, as it's sure to be an interesting winter. So let's start with this slide, expected generation offline by merit. This is basically the generation outages that are expected over the course of the winter. The data is pulled from IIR. And what we're seeing here is that generation outages are expected to remain relatively low, between 200 and 600 megs throughout the winter. And there's also no nuke outages expected. But there are some risk periods I was able to define, and we can look at those. The dates we'll start with is January 5th through February 2nd. Here we have the greatest amount of outages at 600 megs, and this time period also corresponds with the Long Mountain to Pleasant Valley outage, and that again is between January 8th and 1/14. So we got to watch out for that risk period. And then one thing to reference last year, for the period February 2nd to February 15th, due to Winter Storm Nemo, that period experienced 5 to 6 gigs of outages. For that period in this coming winter, we're only expecting about 400 megs. So excluding a winter storm event, we are not expecting the generation outages seen as much as last year. All right. And the Winter Reliability Program is a program put in place by the ISO to mitigate fuel-related system reliability issues experienced within New England last winter. So we're going to highlight the main points of the program. The first one being information sharing. Control room operators are allowed to share generator-specific information with the gas pipelines. There's the earlier dam schedule. If anyone's been involved in the market in May, the day-ahead market close is now at 10 versus 12. This provides gas-fired resources more time to line up fuel. We're also increasing the forward reserves. ISO maintains 10-minute reserves adequate to recover the loss of 125% of the largest source of supply. They've expanded the shortage event trigger to also include a deficiency of 30-minute operating reserves. The greater flexibility part, just make a note that this starts in December 2014, so next year. Units will be allowed to change their offers in the real time, submit hourly offers, and then submit negative offers if need be. And then one of the most important parts we believe of the program is the oil inventories. Selected MPS with oil-fired assets will establish minimum amount of oil inventories in tanks by 12/1. So essentially, these units had to have enough oil on site come December 1st to receive the award payments in the program. The units had to test the ability to see if they could swap between their gas to their oil generation, and then the fuel awards will be made to the individual generators. Basically, the intentions are to make sure that units have adequate amount of oil on site in case of a NEMO event where their fuel supply becomes disrupted and they're called on to run. Here we have a list of the 15 gas oil switchers in New England, just to highlight that these will be important units in this coming winter as we're receiving award payments for the reliability program, and an increase in oil generation is expected. And below we have a pie graph that shows on peak winter days it's possible for oil to make up as much as 21% of the New England supply stack. So in this slide we try to calculate what the additional effect of oil would be in the New England supply stack during the expensive gas days of February 2013. During NEMO, oil units were restricted from running as they did not have an adequate amount of oil on site and they could not receive additional fuel due to delivery constraints. So the two days we used were February 11th, 2013 and February 13th. So on 2/11 we had about 1.7 gigs of oil in the supply stack. That day settled about $253 with AGT price of $31.50. Now when we added 965 megs of oil, or about 2 units to the supply stack, that brought the price down from $253 to about $208.57, a $44 decrease, and it brought the heat rate down from 8.03 to 662. Now on February 13th, we had about a gig of oil in the supply stack, and we added 965 megs, and that caused the price to go from $204 to $179, basically a $25 decrease. And one thing to note is that, as you can see, with the higher gas price on February 11th, the increase in oil was decreased the price further as we're displacing the amount of gas generation pricing off that high fuel price. So here we analyze the relationship between temps and imports received from our northern neighbors. We don't have a great amount of information on the Canadian regions, so we believe temps would be a good way to correlate the flows. And what we saw was that with phase 1 and 2, flows remained relatively constant throughout the whole winter. Even as temps dipped to 10 degrees in Boston, flows were only reduced to about 1,200 megs from phase 1 and 2. So that is a relatively constant interface. New Brunswick, on the other hand, showed a linear relationship to temperature swings. We could see that with temps 20 degrees or below, no more than 230 megs of imports should be expected. This is because New Brunswick has a small generation stack, and as heating load develops in that region, their ability to export into New England diminishes quickly. The two other interfaces we analyzed were the HQ line in New York versus Montreal temps. We believe this was a good line to analyze to judge the health of the supply stack in New York and how much imports they're receiving. And what we saw was that as temps decrease in Montreal, flows over the HQ line are reduced significantly. As temps approach 0 degrees, very little imports should be expected into New York over the HQ line. And the last interface we analyzed was the NYAC line versus Boston temps. The data shows that imports over NYAC are sensitive to temperature, but will remain net imports into New England for most of the winter. As temps dip below 20 degrees, a reduction in imports should be expected. And now we're going to give it over to Wei Chen, our gas analyst, where she's going to give her expectations of the Northeast gas market this coming winter.
Hi, this is Wei. I'm going to talk about our winter outlook for natural gas in New England and how we think Algonquin City Gate will continue to be a weather-driven play. On the supply side, So infrastructure and constraints remain the same, with expansions realized no sooner than 2016. Deepened production will help, but at 200 MCF a day, it will not be an overhaul of the supply and demand balance. Sable Island production is declining, and we think Canapor LNG terminal storage is fairly full at about 7 BCF right now, and we remain skeptical about whether there will be more deliveries at Canapor. And currently, our algorithm sees no incoming shifts at this time. On the demand side, we observe high correlation between residential and commercial demand and temperature. Demand from the power plants oftentimes gets squeezed out by ResCom demand, and those gas-fired power plants are backed up with oil-fired generators. Next slide, please. So how do we deliver the gas to the demand market? There's no onshore production or storage facilities in New England. New England has to rely on imports to meet the demand. In the past winter during the cold, New England has limited options with natural gas supply and often maxed out the imports. From the south, Algonquin brings in gas from the Mid-Atlantic. The southeast compressor station is always at capacity. Iroquois maxed out its imports gas from Canada via Waddington, and TGP is at capacity at station 245. Depending on Eastern Canada demand, Portland maxed out the imports from Canada at Pittsburgh. So you can see that pretty much in the New England pipeline is pretty constrained. Maritimes and Northeast brings gas down from the north from Eastern Canada, which is sourced from offshore production at Deep Panuke and Sable Island, as well as Canapor LNG terminal. Has to flow from TGP onto the Algonquin at Mawa. However, since the segment in Western Canada is already flowing at capacity during the winter, the additional gas that came online due to Northeast Upgrade Project will not reach Algonquin City Gate. Instead, this additional gas is flowing south to meet New York and New Jersey demand. Spectra Energy also has begun pre-filing process with regulators for the Algonquin Incremental Market Project, which would add about 0.42 BCF a day to Algonquin gas transmission capacity through New York, Connecticut, and Massachusetts. This project is currently expected to be in service in 2016, so it will not make any impact in the coming winter. Next slide, please. While constraints from imports from southern regions is due to pipeline capacities, constraints for imports from northern regions is due to production. Trans-Canada imports connecting to Portland is usually maxed out at around 200 MCF a day. And then there's the imports via Maritimes and Northeast. Maritime North and Northeast pipeline runs from Nova Scotia, New Brunswick through Maine and New Hampshire into Massachusetts. So Maritimes and Northeast brings in offshore production, which would be Sable and Deep Panuke. Gas source from LNG imports into Canada at Canapor LNG terminal in St. John's also flow through Maritimes as well. Before the supply sources can reach to the U.S., however, they must first meet the demand of Nova Scotia and New Brunswick, which is about 200 MCF a day during the winter. Next slide. So Genscape's spring rock production forecast is calling 360 MCF a day of dry production for this winter in Eastern Canada, which translates to about 225 MCF a day year-on-year increase. Production at Sable Island has declined in the past 2 years on top of the frequent production outages and gas quality issues. In Canada's Deep Panuke gas field off of Nova Scotia came online in August, and currently there are 4 producing wells with a total production of 175 to 200 MCF a day. Once the processing system is complete, it will be able to pump out up to 300 MCF a day. Although it is unknown when it will be online, and Canada has a history of overpromise and underdeliver. Cooler temperatures in the later half of October has prompted imports from New Brunswick production to drop to 0 and even went to negative in the second week of November. Deep Panuke's production may only just be enough to support demand in New Brunswick and Nova Scotia. Next slide, please. So let's take a quick look at the overall demand before we get into the details. The natural gas consumption in New England during winter is mostly comprised of heating demand from residential and commercial customers. During the winter, Rescom heating demand range from half a BCF a day to as high as 2.1 BCF per day. And this weather-adjusted demand has been consistent in the past 3 years. Power demand declined by 0.3 BCF year-on-year for December to February last winter. Coal-fired generation increased while gas-fired generation decreased. Industrial demand can split into a base and a heating component, and the industrial base demand averaged about 0.3 BCF a day throughout the year, while the heating component ranged from 0 to 0.2 BCF a day. We'll go into more details in a later slide. So industrial demand. This graph on the right shows how daily industrial demand by month correlates with Boston temperature. The higher R² here reflects the heating component of industrial demand. There's a heating component with demand peaking in January or February, and we're currently expecting industrial demand to be around 380 MMCF a day for this coming winter with normal weather. Next slide, please. Residential and commercial demand. With the majority of the homes in the region heated with natural gas, New England residential and commercial demand are highly correlated with temperature, with an R² of 99%. That's really high. Demand in the past 3 years have all peaked in January, the coldest month of the year. The heating demand met by LDCs are price insensitive, and this is very important because LDC's primary goal is to make sure that customers' needs for gas are met and that the cost of gas is passed on to consumers. Therefore, LDCs are not as sensitive to prices as power plant operators are. Rescom heating demand has the potential to go as high as 2.9 BCF a day on an uncommonly cold day. In February this year, a few cold spikes have caused residential commercial demand to consume the majority of the gas supply and prompted an outage, a shortage of gas for power plant operators. We expect Rescom demand to be around 1.65 BCF a day for this coming winter with normal weather, but our forecast is calling for colder weather, which may increase the demand by 150 MCF a day in February. Next slide, please. This graph demonstrated how Algonquin City Gate basis prices would blow out oftentimes when Northeast Rescom demand goes over 2.1 BCF a day. So when weather is cold, the New England Rescom demand is high. LDCs whose demand is based on weather and not sensitive to gas cash prices will be overly aggressive in their gas bids. And LDCs sometimes, well oftentimes, will also have the contractual privilege to cut gas deliveries to power plants if they share the same delivery point. Power plant operators, on the other hand, will go to a price level high enough to push gas plants out of the power generation stack. Next slide, please. Demand from power plants. So this is a graph of daily power demand by month plotted against Boston temperature. The demand for gas from power plants is crucial in determining the prices of Algonquin City Gate. It can be seen that the relationship between gas consumption by power plants in the winter has changed from winter of 2012-2013 versus the previous winters. Next slide, please. Just an overview on where we think New England gas market is going to go. We see that trading Algonquin City Gate basis is still a weather play. So we're expecting blowout whenever weather gets really cold. Mid-Atlantic imports into New England are constrained at Algonquin Stony Point compressor station, so that remains the same. Canadian imports into New England are constrained at the border on Portland and are bound by limited offshore production and minimal LNG imports through Maritimes and Northeast Pipeline. We're seeing the Panuke production increase being offset by Sable Island production decline and Kenneport LNG terminal send-out, the uncertainty around how much LNG deliveries we're actually going to get at Kenneport. And despite the recent increase in Marcellus takeaway capacity, this gas is still not able to make it to New England and actually make a difference in Algonquin City Gate deliveries. New England ResCom demand and industrial demand are relatively insensitive to prices. And when weather gets cold, the increase in ResCom demand forces power plant operators to put up gas cash prices. And gas-fired power plants are backed up with oil-fired generators. And most important of all, we see that when Algonquin City Gate delivery surpasses about 1 BCF a day, the chance of Algonquin City Gate basis blowout will increase dramatically. I'm going to pass it back on to Jesse.
Thanks, Wei. So just to conclude our webinar, so just as a summary, we do expect that this winter is going to be slightly colder than on average. So a couple of degrees with the coldest months in January and warm up relative to January and February. So, but still remains 1 or 2 degrees below. On the import-export side, definitely look out for this D rate that we're seeing this week. It's keeping imports from New York down to $5.50, and the similar in February. In addition, in similar situation, the first, or I think, second week of January, when we're going to have the similar D rate as well, and a bit more generation outages. So definitely bullish mass hub. But just as a note, like what we've noticed this week, we're at the same time are not exporting to crosstown cable, so it's sort of there's a bit of a balance in the flows at this point. Gas-wise, we're not saying that the gas prices are going to be near teens, what we saw a couple of years ago. It's definitely up there with pipeline constraints, etc. The main takeaway is that we don't think we're going to have such strong pricing as last year, the $34. We thought that was an outlier just because there were so many things came to play, like the lack of oil inventories, the cold weather snap, etc. But we do anticipate an average range of 14, 16 to 17 gas pricing. I mean, for tomorrow's dam, so far I think we'll have 20 plus $21 gas price. We do have less generation and outage this year versus last year. We anticipate more oil reserves just with winter reliability. They're ready for this winter. I mean, that's more of our speculation, even less gas demand due to those dual-fired units running more on oil rather than numbing gas, so that may decrease the pull on those pipelines. Possible self-schedule by all units by the end of the winter if they're left with too much in stock, but ISO is planning to dispatch them on merit. So in overall, we do anticipate 2013, 2014 be bearish compared to last year, but we still do think it's going to be a pretty strong winter pricing just with the gas pipelines and the infrastructure that we have in New England at this point. So that's pretty much it. We do have one question.
Hey guys, this is Jesse. One question we received is what oil pricing were we using when we added an additional 935 megs to oil of our supply stack? And the oil price we're using in our model is $16.37.
We have a question about higher Algonquin pricing. I mean, it's been trading $20. We've seen a $21 close to settle. What we're saying is that consistent the $34 that we saw last year, it was definitely more of a combination of the blizzard that we saw, the oil reserves that were low that couldn't step in. And that's pretty much our overall outlook on this. We do think the gas pricing are going to be strong, but if you saw like the first couple of slides for the past 5 years, it hadn't climbed that far up, and last year was the first time since 2009 that we saw such strong pricing in New England. So that's where our conclusions are coming from.
These guys all left.
All right, so that's pretty much it. We'll wrap it up. If you do have any questions, please email us, or if you have any questions or if you'd like to request a free 2-week trial, please go into info.genscape.com, power-market-intelligence. Displayed are our contact info. If you have any questions and you want to contact us one-on-one, we'll definitely be happy to answer anything. And those slides will be available as well as recording for everybody who has attended. Thank you so much.